The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It is time for On the Money. We're coming to you Thursday, Friday, and Saturdays, so hopefully you'll pick up 1, 2, or 3 of those days and hear what we have to say. I want to start by reflecting back a little bit, one on the Obama administration. What was the greatest accomplishment of the Obama administration? And the right answer is not to say nothing. You know, there were accomplishments during that administration, and I believe that the biggest accomplishment was something that was passed in 2012 called the Jobs Act. Jumpstart our business startups. It allowed crowdfunding. We're going to get to that as we go in the program. But before we get to that, I want to take you back to 1957. Two men, Ken Olson and Harlan Anderson, were engineers at an MIT Lincoln lab. And they had a business plan. They had a business plan for a computer company, and they couldn't find anyone that was really interested. Can you imagine today someone not being interested in funding a computer company? But a number of people had tried to form small companies that failed. You know, RCA had tried, GE had tried. Neither one could make a profit. But at the same time, there was a guy by the name of George Doriot who began as a professor at Harvard in 1926, and he founded a company called the American Research and Development Corporation, ARDC. Prior to that time, if you go back and look at how companies got funded, you had Mellon, for example, that funded U.S. Steel and funded Alcoa. You had angel investors who had created wealth, and then they went out and invested in new startups. But ARDC took a different approach. They brought several investors together, they pooled their money, and with that pooled money, they made several investments. And they were the first investors in this small computer company that Ken Olson and Harlan Anderson, those engineers from MIT, had come up with this little company to build a computer. And they invested a total of $70,000 in a company called Digital Equipment Corporation, DEC. You know, there's a computer museum on First Avenue in Seattle. If you go down to the computer museum, you'll actually see one of the DEC computers. Very interesting if you want to take visitors from out of town, or if you want to go see. Just go see the computer museum. But there is a DEC computer, Digital Equipment Corporation. It was that company that when it came public, that $70,000 investment went public at $38 million. They had brought together several people to invest in a number of companies, and a $70,000 investment became $38 million. And that launched a whole new industry of financing startups. That really launched the venture capital industry. And if you look at the impact, by 2007, going back before the Great Recession, the companies founded by entrepreneurs, the little guys, and backed by venture capital, had created 10.4 million jobs in 2007 alone. Those companies generated $2.3 trillion in revenues. Venture capital companies generated 18% of GDP and over 20% of R&D spending. All of that in 2007, and that, of course, has grown even greater since 2007 in the last 10 years. Of the public companies founded since 1979, 43%, 574 companies, were venture capital financed. Of all the public companies founded since 1979, and there were 1,380, 574 were financed by venture capital. 57% of all market capitalization, if you take all the companies that are public today, multiply their share price by the number of shares outstanding, you'll find that 57% of market capitalization belongs to companies that were venture capital financed. 38% of all employees are employees of companies that were venture capital financed. And the growth of R&D, if you look not at the total R&D, but if you look at the growth and how much the growth is coming in R&D, it's growing at 82% a year. That's the companies that are financed by venture capital. Think of it. There's local companies, the Microsofts, the Apples, the Amazons. Those companies were financed with venture capital. While large companies tend to make small improvements and improvements to existing products, the innovative companies that created the digital technology, disruptive technology, that suddenly it comes onto the marketplace without people thinking, a lot of that came in the 80s, the 70s, and 90s through venture capital financing. And venture capital financing continues to finance a lot of those companies. They tend to be companies that are breakthrough. William Nordhaus of Yale said 70% of the goods and services that existed in 2000 did not exist in 1900. 70% didn't exist. And my guess is that by 2060, 70% of the goods that exist today will not be in service in 2060. Venture capital, however, is financing mostly large companies. The success they've had has meant they have grown large as well. So what is the answer to the question, what did the Jobs Act do? Jumpstart our business startups? It allowed crowdfunding. You can do online investing for as little as $1,000. Actually, you can do it for even a lot less than that. And crowdfunding can provide equity ownership. It can happen anywhere in the world. Today, there's over 2,000 crowdfunding sites that exist, with an average, on a worldwide basis, of $7,000 per campaign. An average campaign worldwide takes about 9 weeks. But if you look at just the U.S., there's 350 projects that are coming out every day. In 2015, there were 15,515 campaigns with an average pledge of $94. Actually, that's the worldwide number. In the U.S., the average size of campaign was $31,118. That 119 is very important if you think about it. Not really. And most of the funding has come from people that are 24 to 35 years of age. It's a young person's investment. Very unlikely to find people over 45. On the other hand, most of the people that are doing crowdfunding are people with incomes of over $100,000. So look around. In Seattle, you begin to see those people who can do crowdfunding, but it's not just in Seattle. It's not just in the U.S. Crowdfunding is happening around the world. Crowdfunding in 2010 raised $880 million. By 2014, it had increased to $13 billion. By 2015, to $34 billion. And last year, well over $50 billion went into crowdfunding. By 2025, the estimate is that crowdfunding will raise $300 billion. Compare that now to venture capital. Venture capital raises less than $100 billion per year. And yet by 2025, the estimate is that crowdfunding will raise 3 times, at least 3 times, maybe more than venture capital raised. Why is that important? If you look at the companies that exist today, a good portion of them were venture capital financed. If you look at the time in which venture capital played a major role, you look at the bull market from 1982 to 2000, 18 years, when the market went from 1,000 to over 10,000, the public market. The Dow went from 1,000 to over 10,000. Many of the companies that came into existence at that time and added growth and added the value to their shareholders, many of those companies were venture capital financed. There has to be financing to keep the market going. You know that I've talked a great deal about the super cycle, and we're going to come back to that right after the commercial break and see how all this comes together. Don't go away. And you want to hear my guest today, who has been a participant in crowdfunding. Don't go away. I'll be right back after the break.
Come gather round, people, wherever you roam, and admit that the waters around you have.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I've been talking about what I think is the greatest achievement of the Obama administration, and that is the Jobs Act. Not jobs as you think about it, but JOBS, which stands for Jumpstart Our Business Startups. It was an act passed to allow companies to crowdfund their ventures. Crowdfunding, something that is providing and will provide the fuel for a sustained secular bull market. I've been talking over the past 7 or 8 years, since very early in this program time, of the study that Standard Chartered Bank did. And Standard Chartered Bank said that there were periods of time in which worldwide GDP grew much faster than the average. Time from 1870 to 1913, when it was driven primarily by the industrialization of the United States. 40 years. From 1945 to 1970, a period of 25 years, driven by the rebuilding of Europe, the decolonization of the world, and the U.S. building the infrastructure. They're saying now, 2009, a new supercycle began, and we've seen that impact. We've seen the Dow rise from 6,600 in March of 2009 to over 21,000 now. And we've seen that happening as the world GDP is growing. Other countries are seeing an increase. I've talked about the impact of the decrease in poverty, which has been dramatic in places like China and India and around the world, moving people from subsistence to actual consumers of products. We're seeing that worldwide. And along with that, we will see the rise of companies, but those companies need funding. In the 1982 to 2000 secular bull market, a good deal of that funding came from venture capital. But venture capital has become more and more restrictive and more focused on large companies and is being replaced by crowdfunding. Crowdfunding has opened the possibilities to worldwide raising of funds, not just for U.S. companies, but for companies around the world. And the amount that's expected to be raised by crowdfunding by the year 2025 is at least 3 times larger than venture capital will raise. In 2010, it raised less than $1 billion. By 2025, the expectation is it will be $300 billion, and that money will be going into equity capital. A good portion of that will be flowing into equity capital to finance growing companies, innovative companies, disruptive companies, which will really make a change in the world. That's where we are. That's the background. And that's the background I wanted to lay out for my guest today. My guest today has been involved in crowdfunding, and he's got a lot of insights that you want to hear. My guest today is the president of Loan Shark Games. Welcome to the program, Mike Selinker.
Hey, it's great to be back.
So Mike's been on the program a couple times before, but why don't we start with a little bit of your background before we get to the crowdfunding?
I mean, fundamentally, I'm a game designer. I design games both for the electronic market and for the tabletop home market, sometimes online, things like that. I worked for a big company before. I worked for Hasbro for Wizards of the Coast, Hasbro's Wizards of the Coast division. I was a creative director there. But in 2003, I decided that working for a big company wasn't really my thing anymore. So I decided to form Loan Shark Games with a friend of mine. And now it's a nice, tiny little company. It's like about 12 people. We're up in Redmond, but we work for Disney. We work for Sony, BioWare, all the big Amazon, Microsoft. We work for companies that are a lot larger than us, and I wouldn't say we're an equal partner, but at least we're taken pretty seriously by those folks. So it's worked out better for me sort of holistically with my life to be my own boss and to have a team of people that really likes working for me rather than working in a $4 billion company where my bosses are 3,000 miles away.
Understood.
Yeah.
Absolutely. I came out of that too.
Yeah, I mean, I just think at some point in your life, you either decide that you're going to be beholden to the wills of people who don't even know your name, or you've got to figure out a way out of that problem. And so that's why we founded it. And it's 13 years ago now, 14 years ago the company's been in existence, and we still feel like a startup. Like pretty much every day, we're figuring out a new innovative way to try to put a cool thing together that we don't really know how to do. And that's a fun place to be, even though I know we're pretty stable. Like we don't seem to be going anywhere, right? So it's a kind of a nice comfort zone, I think.
So when you were first on the program, you were just at the beginning stages. You just raised money, I think, on your first...
On my first one, yeah.
Your first one.
We're over $1 million on crowdfunding now through a couple of different directions, notably through Kickstarter, which is a site I think everybody knows about, and a collaboration with our friends at Humble Bundle, which is is a for-profit but has a charitable connection to it. And so we've done, I think...
But before we get to that...
Oh, sure.
well, you know about Kickstarter. I'm not sure that a lot of our listeners know who Kickstarter is.
Sure. Well, you set this up really beautifully because I think you described a circumstance in the Obama administration where things were very much in flux and the administration could have gone a couple of different directions. Crowdfunding existed in the traditional manner, maybe for or in a manner that vaguely resembles what it is today. Since about 2004 or 5, and Kickstarter, the company, launched in 2007. Very small company out of Manhattan, and just to give an example, your listeners might have heard of a little game called Cards Against Humanity, which is a sort of little party game. It raised $7,000 on Kickstarter and was considered a massive success, right? And so that was the early days of Kickstarter. What people do on Kickstarter is they back projects. They don't back companies. So you display a product that you want to make or a project that you want to do, and then you say, who wants to get a copy of that or get back, if it's a theater thing, get, back our production of this show or whatever. And then the creator, it's an all or nothing thing. You set a goal, and if you don't achieve the goal, then you get nothing. And if you achieve the goal or more of it, then you get all the money minus Kickstarter's fee and minus Square's fee. And then you are expected to deliver that thing. And if you do not deliver that thing, then you are in real trouble. then your ability to crowdfund after that point will be quite difficult. So in our case, through Kickstarter, we've had 5 campaigns. We've completely delivered on 2 of them. We're in the process of delivering on the 3rd. The 4th and the 5th are underway for delivery at the end of this year and the beginning of next year. So we're right in the midst of our projects. Our average campaign size is somewhere between $300,000 and $400,000, which is a decent chunk of change for a game company, right?
But your first game was what,
170,000.
170,000.
That was the first. That was the Maze of Games, and then I can't remember all the details, but I think it was the next one was 333,000, and then our last one was 626,000. I think something like that.
So, the experience of doing it.
It's very different than venture capital, as you might guess. So with venture capital, you're making a pitch to, half a dozen people, and you have to get them excited about it. With a crowdfunding campaign, you have to make a pitch to thousands of people, all of whom have access to the internet and can tell folks what they think about you, right? And you are now making a promise to all those people, and if they don't get what they asked for, then you have not disappointed the 6 people in your venture capital group. You've disappointed 5,000 people, and that is tremendously different. It is like having a lot of different, like having thousands of bosses, and the best creators understand the balance between that and staying true to their own vision and their own timelines and managing the public relations aspects of it. We've done pretty good with that. There are obviously people who would like to have the products immediately after we've finished the campaign, and that doesn't actually work for us. So
it takes a while to do.
Yeah.
We're coming to a commercial break, so
Yes,
don't go away, because we're going to talk about some of the specific projects.
Sure.
We're going to talk about how you go about a crowdfunding situation, because it's very, very different than raising money, as Mike said. It's not 6 people, it's thousands of people. How do you reach thousands of people? We'll come back to talk about that. Don't go away. If you miss any of this program, you'll find a podcast, Adams Financial Concepts. Also on YouTube, you'll find the information. And we're tweeting about this program as we go along. Sarah's here faithfully tweeting out information. So You can like us on About Money. You can add us to your Twitter. So do all that and keep listening, because we'll be right back after this commercial break.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Get away. Get a good job with more pay and you're okay.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So welcome back. I'm talking to Mike Selinker, the president of Loan Shark Games, who has gone through several crowdfunding money raises. So let's come back to this and begin to drill down and talk about crowdfunding itself.
Cool. Well, let's talk about the environment that we're in. You mentioned the Jobs Act, which is a watershed moment for businesses like mine. Crowdfunding existed for a few years before that, but it was impossible to raise equity on crowdfunding. You couldn't back a company. So the credit crunch of the late 2000s was toxic for small businesses in a lot of ways, but thankfully we had a very constructive small business association, small business administration at the time, passed the Jobs Act to allow equity in crowdfunding. The current environment for a small business is a little worrisome to folks. Whatever you think of the environment or the administration, what you have to look at is that the president, the administrator of the Small Business Administration, Linda McMahon, who's from the Wrestling Federation, WWE, argued for the rolling of the Small Business Administration into the Department of Commerce, and thus the entire Jobs Act would disappear, right? I mean, this is a massive difference for people like me. And so, assuming this all continues, I think we're in an environment where the track that you described, comparatively, venture capital has a long way to go to gain as positive a reputation as the new version of crowdfunding. That means now we'll see what the next version of crowdfunding looks like. But right now we're in the very early stages of it, especially in the subject of equity. A company like mine, a small company, has to think, how am I going to raise capital? How am I going to get credit? There's the traditional method of going to a bank. That method was curtailed heavily in the late 2000s. There's the sort of less traditional method of going to venture capital. That method has become somewhat ossified in its approach and has ended up backing larger companies as opposed to smaller, more risky companies. So simultaneously, the rise of Kickstarter and a few other sites, which I'll talk about in a second, have allowed people who have trouble getting credit, who have trouble getting venture capital, to raise, for them, very large sums of money. We work with people we've raised, as I said, about $1 million. We work with people who've raised, $8 million, $10 million. Those are company founding dollar amounts. Those are not trivial amounts of money. And so, but what it comes as is it's raising capital based on promises of work. And if you can't do the work, if you don't do the work, what you get is potentially a toxic association after that point. And so it's a very risky environment. I mean, maybe venture capital is just as risky, I guess, but it feels riskier at this sort of Wild West stage of venture capital versus crowdfunding.
I think it probably is, and it probably will continue to be. But I think it opens the possibility for millions more people, maybe billions of more people, to actually participate in an equity investment than would happen through venture capital, which is a very limited number of people. If you look at Madrona Partners or some of the others, they have a very small base of partners, whereas crowdfunding, if you look at the crowdfunding you did through thousands of people to get.
Right. Yeah, I mean, I think for some people it's a little bit like gambling. It's a little bit like playing the stock market, trying to make sure you back solid decisions, but still being willing to take a shot. For other people, it's buying a product. It's whatever it is that is, I want. I don't care about whether or not the company does well. I just care about my thing. And for a very different group of people, it is, I wish to make a reputation in this environment so that I can raise money, right? Mm-hmm. Like you don't want to go into crowdfunding never having been making something through crowdfunding after not being around crowdfunding, because they'll smell you out and they'll know you're an outsider and they won't back you. You have to do quite a bit of work on being crowdfunding, having a positive image before you do that. You do all your work before you actually launch something.
So how do you reach thousands of people?
Well, first it helps to know thousands of people. It starts with the basics of whatever marketing is, whether it's an art or a science, I'm not sure. But at the minimum, you have to do the things that that good companies do, like have a well-followed Twitter account and have a good public presence on Facebook, and in my case, the games industry, go to conventions and in some cases take out ads, although that business has been interestingly contracting for a lot of environments. Magazines are very difficult to raise funds for these days, right? As subscriptions have dropped off, newspapers no longer seem to be a place that you can guarantee eyeballs on what you're creating. Websites are shaky because people jump around from site to site all the time. And so these crowdfunding sites actually become marketing sites. Sometimes you can imagine doing a crowdfunding campaign even if you don't need the money at all. You just do it because you want the people who support crowdfunding to see your thing. And that's crazy, right? Like that concept has never existed. When Spike Lee decided to crowdfund a film of his, people reacted very negatively to that. Spike, don't you have money? It looks like you have money, right? And the point wasn't to do that for him. The point was to create a community-funded project that people could get behind. He could have made that film on his own without any help from anyone, but he wanted a thing that was not dependent on studio money and was, essentially that people could buy into, which I think is pretty fascinating. I think that it contributes to crowdfunding sort of have this feel-good attitude that I don't think venture capital has.
No. And I think it's one of those things where you get involved with the people who are crowdfunding, who are giving. And of course, in your case, it's been a game, but we're seeing now the beginning of equity crowdfunding, where people can actually buy equity in companies.
Right.
And that's a very big difference.
Yeah. In our case, for video game companies especially, this will be different for every industry, and I'm sure that there's parallels in every industry. I only know mine really well, right? But so Kickstarter is project-based funding. Do you want this thing? Put in $100, you get that thing, right? But there are many other ways, two very specific ones. One is the concept of this company called Fig. Fig is buying equity in upcoming video game companies. You can also buy the project, but fundamentally Fig exists so that people can back a company and own part of that company. And Fig is an environment where you can subdivide your company in a weird way, so that you could say you're only buying part of this company for the thing that we're doing, but you're not buying into the whole company, which is kind of interesting. And the third way is Patreon. Patreon is, I want to support you, period. I want to give you money every month to make cool things for me. All three are very different, and they have interesting ramifications as to which one you pick.
Well, it's an evolving kind of funding. I think it's key to what we will see for the rest of this business cycle. And I really appreciate you being back again.
Absolutely.
To explain what you've been doing. And check out the website, Lone Shark Games, right?
Yeah, lonesharkgames.com. Come check out what we do.
Check out what they do, and maybe get involved with their next crowdfunding deal. Anyway, we're coming to an end. I want to talk about how this whole bull market ends. I think it's going to be a while in going, but I think there's a time to be prepared. So don't go away. We'll be coming right back after this commercial break. And as I said, follow us on Twitter, follow us on Facebook, and check us out on YouTube and any previous programs you missed. Be right back after this commercial break. Don't go away.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and probably, most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019 or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I've been talking about this secular bull market for a number of years, and I believe it's going to continue for a number of additional years. But you hear constantly, or I hear that constantly when I hear CNBC, when I read in the newspapers, when I read in journals, about this bull market, which is 8 years old and coming to an end, dying of old age. Recently, the Hindenburg concept came up again. Hindenburg, the blimp that blew up and burned up. There's a guy that promotes the Hindenburg, and I forget the actual name, but it's the Hindenburg issue that he's got this chart that he does with and looks at the chart and the different trends within it and finds that there's going to be a complete blow up. That just came out this last week. A complete blow up of the market. Bob Various did a column in the Financial Advisor magazine in which he said, if you want to become a noted financial advisor, just call a TV reporter or a TV channel host and pick any old day and tell them that the market is just going to come into a disaster. And he gave some examples of when that has happened in the past. He gave the example of Andrew Roberts, Royal Bank of Scotland, who came out and said that we were on the edge of a cliff, that we were just around a corner and the banking system was going to collapse. Think the unthinkable. Think the unthinkable. It's going to happen. It's going to happen soon. Now, thing is, I didn't tell you, that was in June of 2010, 7 years ago. Think the unthinkable. It was just around the corner. It's been a pretty long corner. Mark Faber, also in May of 2010, said things are going to collapse. In 2009, actually, he predicted hyperinflation of over 100%. The Fed was injecting money into the system. We were going to see inflation that was way beyond what they saw in Zimbabwe, 100% a year, even more, even up to 100% per month. Now, as I look around, I have not seen hyperinflation. In fact, we're not seeing much inflation at all, but I want to get to that because we will see some inflation. And from 2013, he began to predict that we were going to be in a 1987 type crash without any warning. One day the market was just going to simply collapse. Michael Lombardi, Profit Confidentials, predicted a great crash in 2013. Here we are in 2017. It hasn't happened. Fear sells. Actually, fear sells. How will this market end? A lot of people will predict that fear sells. Levitt and Dubner actually wrote a book called Freakonomics and point out that fear thrives in the present time. And they didn't use the market as examples, but they used some other examples. Professionals, they said, rely on it. Experts rely on it. Imagine a government that had to deal with two situations. One, terrorist attacks, or fund heart disease. Do you fund prevention of terrorist attacks, or do you fund prevention of heart disease? Which do you think Congress would fund? Which do you think would be more in the newspapers? For sure, it's going to be terrorist attacks. Think about what's going on. Since 2000, we've had 4,000 people killed in terrorist attacks. And about 3,000 of those happened on 9/11. 4,000 people killed in terrorist attacks and 3,000 in 9/11. You know how many heart attacks we have? 17.3 million. 17.3 versus 4,000. I mean, the funding source is not based on prevention. It's based on the fear. And the fear is sold by experts predicting the end of the market. The market has come from 6,000 to 21,000. It's going to collapse. And it makes logical sense to a lot of people. But the reality is, I don't believe we're going to see that kind of collapse. I believe that what we're going to see is something completely different. It's impossible to say. I don't have a crystal ball that's accurate, but it's impossible to say exactly what's going to happen to this secular bull market. I believe it's going to continue for a number of years, and it will come to an end. That we can almost say for sure. Just as you can say, it's sunny today, but it's going to rain. I can't tell you when it's going to rain, but living in Seattle, I can tell you it's going to rain with a very high probability. Very, very high probability. This market will come to an end someday. And we can prepare for how that's going to happen. You know, if you look back and see what happened in the 1929, 1930 Great Depression and all the stories of the people that lost money, the businesses that went out, the high unemployment and the difficulty of jobs and the difficulty of living through those times, when that generation came to power, they wanted to make sure there was not going to be another Great Depression, and they were willing to inflate their way out of it. So when we started to see inflation in the 60s and 70s, they were willing to continue the inflation to make sure that we didn't go into a Great Depression. We ended up with the 70s recession that became stagflation because we had a slowdown in the economy, but we also had inflation going on. But that was the generation. That's our generation that grew up during that time. And as we reached the 2000s, we wanted to make sure we didn't go through another time of high inflation. Central banks around the world set inflation targets of 2% per year, willing to risk a Great Depression to make sure we didn't get into that high inflation. And we did. We got the Great Recession. We did not get high inflation. We got the Great Recession. My guess is that what we will see, the end to this market, is a growth of inflation. In the 50s and 60s, from the 1950s to 1965, inflation ran 1% to 2%. 1965, it reached 1.6. It would continue to climb until in the late 70s, it reached almost 20%. Not quite. If you look 2010 to 2015, we had less than 1%. Last year, we had 1.5%. And there's appearance that inflation is beginning to pick up again. By 1970, inflation had reached 5.5%. 5.7%. Nobody was really talking much about inflation until we had the oil embargo. In 73, 6.1, and by 74, 11%. That's when people really began to notice. But inflation had been going for a number of years. And during that time, we had a very solid market. I believe we have to prepare for that time. We can be conscious of a dip the other way, but we have to prepare for a pickup of inflation and monitor that. I believe that's the way the secular bull market will probably end. Not of old age, but of high inflation. We'll talk more about that as the weeks come. Join me next week, and I will be back with more about money.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following program sponsored